Two shops on the street sell the same smartphone. One is priced at $5,000, the other at $5,500. You definitely think the $5,000 one is a better deal, right? Now what about two chip-making stocks? One costs $100 per share, the other $50. Is the $50 one really cheaper? Not really, because a stock represents a company, not a smartphone. The $100 one could be very cheap, and the $50 one could be outrageously expensive. How do you tell? With one indicator, the PE ratio. Today, in just one video, we'll get you fully up to speed on the PE ratio. P/E ratio, short for price to earnings ratio. The formula is dead simple. P/E equals stock price divided by earnings per share. What does that mean? Think of it this way. If a company earns $1 per year, how much would you be willing to pay for it? Pay $10 and the PE is 10 times. Pay $100 and the PE is 100 times. The PE ratio is simply the price you pay for every $1 of profit. There's also a more intuitive way to understand it. Payback period. A PE of 10 means that at current earnings, it would take you roughly 10 years to recoup your investment. A PE of 100, that's 100 years. Open any trading app and you'll see several different PE numbers. Don't get confused, there are only three types. First, the trailing PE, static PE. It uses last year's net profit. The advantage is that the data is real. The disadvantage, by the second half of the year, you're still looking at last year's numbers? That's like using last year's weather forecast to decide what to wear today. Not very reliable, right? Second, the forward PE uses forecasted net profit. The upside is that it looks to the future. The downside, well, forecasts are only as good as the analyst who makes them. Third, the trailing 12 months PE, or TTM. It uses the profit from the most recent 12 months. It's fresh and accurate, the most commonly used one. Remember this, trailing looks at the past, forward looks at the future, and TTM looks at the present. You can't just look at the PE number in isolation. Is 30 times expensive or cheap? It depends on who you're comparing it with. First, compare horizontally against peers in the same industry. Take tech giants. Apple trades at around 37 times, Amazon around 35 times, and Nvidia around 41 times. If you find another tech stock with a PE of over 100 times while its peers are only at 30 to 40 times, you have to ask, why? Second, compare vertically against its own historical PE. If a stock has averaged a 30 times PE over the past 5 years and now it's down to 15 times, if the company's fundamentals haven't deteriorated, that could be an opportunity. Conversely, if it spikes to 60 times without earnings catching up, then be careful. Third, factor in growth. Use the PEG ratio. PEG equals P over E divided by earnings growth rate. PEG approximately equals 1 is considered fair. Greater than 1 may be overvalued, less than 1 may be undervalued. Let's look at an extreme example. Tesla. In September 2025, Tesla's stock price was $444, with EPS of $1.45, giving a PE of a staggering 306 times. 306 years to pay back? Sounds crazy, right? But why is the market willing to pay such a high valuation? Because everyone is betting that Tesla will make a lot more money in the future. A high PE is essentially the market paying for the future. So a high PE isn't necessarily expensive. If the company's future profits can multiply several times over, today's 100 times PE could become 20 times tomorrow. But the catch is that if doesn't always happen. Let's look at a classic case, Cisco. At the peak of the dot-com bubble in 2000, Cisco's stock hit $80, and its PE exceeded 200 times. After the bubble burst, Cisco's stock crashed. But here's the interesting part. Cisco's profits kept growing. From 1999 to 2022, Cisco's EPS went from 30 cents to $2.82, a more than 9-fold increase. Profits multiplied by 9, yet the stock price never returned to its 2000 high. What does that tell you? Buying at a 200 times PE means that even if the company's profits grow 9-fold, you may never get your money back. On the flip side, is a low PE always cheap? Not necessarily. Some traditional industry stocks have PEs of only 8 times or 10 times. Looks cheap, right? But if the industry is shrinking and profits are declining, even 10 times could be too expensive. A low PE can be a bargain, or it can be a value trap. Remember, the PE is not a magic bullet. It basically fails in these 3 situations. First, loss-making companies. If earnings are negative, the PE becomes negative and meaningless. Second, cyclical industries like steel, shipping, or semiconductors. When the cycle is booming, profits surge and PEs look temptingly low. When the cycle turns down, profits plunge and PEs shoot up. Buying stocks based on PE at the peak of a cycle is one of the easiest traps to fall into. Third, earnings can be cosmetic. If a company sells off an asset or receives a government subsidy, its profit suddenly jumps and the PE drops. But that's not real operating earnings. It's one-off income. The PE ratio is like the speedometer on your car's dashboard. It tells you how fast you're going, but it doesn't tell you where to turn or what curves lie ahead. To use the PE well, remember 3 things. First, compare horizontally with peers and vertically with its own history. Second, high doesn't necessarily mean expensive, and low doesn't necessarily mean cheap. The key is understanding the why. Third, the PE is a starting point, not the end. Always combine it with PB, cash flow, and industry trends. End with a question. What's the PE of the stocks in your portfolio? Tell me in the comments. Cut through the noise and see the real picture. If you're vibing with this content, smash that like button and subscribe. See you in the next one.